So the question is, in this FD, in the FD tax calculation, how does it work? Can the bank directly deduct tax from interest income, or is it a voluntary thing that we need to do, right? So as of now, it's a voluntary thing that you need to do, right? Say, for example, at the moment, what the bank does is the bank minuses off the withholding tax of 5% and gives the money to you, right? Then you have only paid 5%. So if you're falling into the 36% income tax category, you need to pay another 31% more effectively, right? But you have to voluntarily file your returns. If you're showing your portfolio in your tax files, then you have to declare it and pay it as a separate income tax to the income tax department, right? As of now, there's a fairly large percentage of people who are still have not been don't have tax files or have been identified. But in the future, you'll see this coming in, where the government can track all your investments and so on. The government has invested in sophisticated system. They're getting a system from India in terms of digital NIC. There's been the systems which can track basically the incomes and so on of people, and particularly all financial institutions returns. And if you have an FD in XX bank, all these returns will be accumulated by the system in the future, right? So still, as of now, it is entirely voluntary, but in the future they can identify who these people are who are not kind of paying if their interest income is above X amount of money. Do we have to pay tax after 5 years on fixed income opportunity fund capital? Yes, you have to. So that is also voluntary, right? You don't have to pay WHT because the rates that we quote you are after the withholding tax. So you don't have to worry about the withholding tax, right? But in 5 years' time, if it depends on the interest rate at that time, right? So if the interest rate at that time is say 15%, you need to pay the 15% tax for those 5 years, right? But because you've been postponing the payment, there is a return that you kind of make, right? Because the amount of money that you have not been paying as tax earns the interest for that particular period. So net, you're making a gain compared to paying tax on this particular year. So investment grade daily return fluctuates significantly, even negatives on some days. What is the reason for such variation? So at one particular point, we had this issue, right? Because some instruments were required to be marked to marketed on a particular day basis. We had the issue where, for example, when rates go up, your return comes down and so forth, right? But now, I think from 2 or 3 months ago, we have made it fixed in terms of the returns, right? So you won't see volatility in your funds like what you saw before, right? But keep in mind that volatility helped you in those couple of months before, right? What happened was when rates went up, there was negative returns, but that also helped us make those abnormal returns because when rates came down, right, you saw capital gains on your positions, right? So that fluctuation that you saw 3 months ago is not going to be there because now it's more like a cost plus accrued kind of portfolio. Right. So the next question is, what is the guarantee or safety of the unit trust, right? So to be honest, there is no guarantee or anything. It is a risk. It is compared to a treasury bond. It's obviously a riskier product, right? The good thing with a unit trust is that, say, for example, as a fund management company, we take 100 rupees from you and invest in 10 particular instruments, right? At a given time, you're not going to lose all 10 instruments, right? Because the portfolio that the investment managers are investing is diversified among multiple investors, right? If one particular investment fails, you'll still have 90% of the investment, right? So the portfolio is diversified, right? So it's not like with a financial institution. If the financial institution goes bust, you lose the entire 100% amount out, right? But with a unit trust fund, if one particular instrument falls, right, you only lose 1 out of 10 or 20 out of your investment, right? The second thing is that we've been operational from 2012. We had 0 incidents where there has been no default on a portfolio as such, right? What are the withdrawal conditions on quantitative fund which purely invest in listed equity? To be honest, there is, so we don't, if I'm not mistaken, we don't implement exit fee as such, but when you buy and sell, immediately there is a brokerage impact, because when you're investing like the stock market, when you're buying shares, you're incurring a brokerage percentage, and selling shares, you're incurring a brokerage percentage, right? So if you invest today, right, and the market doesn't change, automatically you are at a loss because it takes into account the commission percentage, right? So because of that, right, your quantitative equity fund needs to go up in terms of performance for you to cover up the brokerage component. So what is a custodian fee in the unit trust? You don't have to worry about the custodian fee because Cal is bearing the cost of it, right? So the returns that you're making is net of all the custodian fee, right? So you don't have to worry about what custodian fee Cal is paying and so on. Is as an investor, you're not paying that tax. It's by the return that we are quoting here, right? And what I say is you can make 20% plus returns in the foreseeable future is after all these fees have been deducted by the fund, right? So what are the rates running on fixed income opportunities fund as at today and the investment grade fund? The rates running, I would now, every day the rate changes, right? But I can tell you that our rates will be above north of 20% for at least a 3 months, depending on, it depends on current, for example, if you have a 30 billion rupee fund and there's another 30 billion rupees fund, we have to find places to park that money. But looking at current conditions, we can give a 20% plus return on both funds is our view, right? And why one fund will be one lower and one fund will be higher is because it depends on the new inflows. Now we see a lot of money starting to come in. If one fund sees a lot of more new money coming in, then of course that return will go down faster because of the new money being have to be parked at lower rates. So where we can get comparison among the different unit trusts. So we have fund fact sheets on our website. So if you go to our unit trust page, you can see the different funds, and there's something called a fund fact sheet where you can see the maturity profile and so on, what I've been talking about. Do we get equity dividends with equity fund? No, we don't. We haven't been declaring dividends with equity fund because we feel that capital appreciation potential is there. So if there's a period where we feel that capital appreciation is limited, then we might want to declare a dividend. But as of now, we don't do that. What is the difference between fixed income opportunities fund and versus the investment grade fund? The investment grade fund is more in terms of credit quality, it only invests in BB plus kind of instruments, right? And a lot and these are relatively high in terms of credit quality compared to the fixed income opportunities fund, which can slightly go down in the scale in terms of investing in a more riskier kind of product, right? Is there a particular confirmation issued on the unit holder's income if there's a request by IRD? This is to verify the realized income on fixed income security. Now, is there a particular confirmation issued on the unit holder's income? So the thing is, the terminology now, what you get on the unit trust return is not a realized income, right? So in the IRD, whatever, it's mentioned as that any realized return will be subject to income tax, right? But now we've been working on this for a long time. If the income is not realized, if you haven't withdrawn the money, then you can comfortably kind of postpone the payment, right? Not that you're not paying taxes, right? The idea is that you're postponing the taxes, right? Because when you're withdrawing, even if you invest in FD, right? If you have an FD which is giving you interest at maturity in 5 years' time, you only have to pay tax in 5 years' time when you're getting that interest component, right? Could you potentially lose a portion of your or the entirety of your invested capital when investing in unit trust fund? Yes, you can, right? Like what I mentioned, apart from treasury bills and treasury bonds, which are considered risk-free, but we've seen a period where those have also been considered risky. Any fixed income investment or any financial instrument can be subject to a default, right? But as I mentioned, the thing is that the diversification benefit and our credit quality evaluation ensures that this doesn't happen. So which is why I said we have a track record where we haven't seen any defaults on our funds as of now. There's a question in terms of how often do fund management companies furnish information to the Department of Inland Revenue? To be honest, as of now, they have not asked us for it, and we haven't also not kind of furnished it. But at the end of the day, at one particular point, everything is going to be tracked. So just keep in mind. But as of now, to be honest, it's not something that we give or they have been kind of asking for as well. Any Shariah investments available? At the moment, no, but we are trying to develop a product which might come to the market very soon. So if you want to learn about this unit trust product, go to our YouTube page and we have videos telling you how it works, what the benefit is. It looks too good to be true because the rates are good. I know, I understand where your concern comes from, but as I mentioned, it is because of our positioning in the market and you know that rates were high at a particular period, which is why we've been able to lock in and kind of give those returns, right? So it's all on proper credit evaluation and things like that we do to evaluate and make decisions as such. There's a question in terms of why did ASPI come down over the last few years, last few days. So one reason it came down was there was a bit of profit taking because people have made money. Second one was the postponement of the domestic debt exchange program, right? Because of the postponement, what happened was people thought, okay, there could be some problem with attached to a domestic debt exchange and so on. But to be honest, as at 31st August, the likely scenario is that will be comfortably passed through. So you won't see too much of an issue in terms of that being a problem, right? The other thing was we saw a bit of foreign selling on few shares, right? And that kind of drove the market down. But now we are seeing kind of the interest kind of building back again, right? What you need to look at is the overall trend. It's good if there is some adjustment when it goes up. Continuously markets going up are not healthy, right? We've seen what happened in the 2020 to 22 run, right? Markets went crazy and then it adjusts itself, right? But this run has been more cleaner. We've seen fundamental companies go up more, and it's being a more it adjusts itself when it goes up. But the overall trend is good, right? And when rates are kind of coming down, you're going to see that kind of market movement continuing. I'm unable to kind of comment on individual shares. Our research division will do a presentation on particular companies that they're interested in and why they would recommend it. At that point, I think we could answer the questions that you have on the individual counters. Can we switch between unit trust funds? Is it advisable? Yes, you should be switching between unit trust funds. Depends on the timing. Say, for example, you're seeing inflows coming to one particular fund more, then to be honest, it might make sense to shift it to the other fund, right? So there's no cost involved in terms of you shifting. It's a matter of logging into the cal portal and just say switch funds or whatever that option is, and you can shift from one fund to another. And keep in mind the advantage is that you can shift from fixed income funds to into the share market. You can use the portal to manage your entire portfolio. So you don't have to be running between financial institutions to do this. You can manage your investments within this portal by moving your assets around, and you're not incurring cost, or you don't have to go to a bank to transfer funds and so on under this system. Does switching between unit trust fund consider realization for taxes? Yes, it is considered. So if you keep switching, to be honest, then it means that you're realizing income and then you have to pay taxes, right? So from a taxation perspective, you're looking at if you're falling into that category, recommendation is that you don't do kind of you avoid switching, because switching means you're realizing the funds. So that's about in terms of our session. So what we'll do is there are a few equity related questions that were asked by our customers. Our research division will have our recommendations and so on being published in the equity session. But what we'll do is on a monthly basis or so connect with you in terms of telling you what has changed and in that kind of context how you need to kind of tilt your portfolio. If you have any questions, you can contact us via email or even on our social media pages. You can drop messages and we will be able to respond to you. Thank you so much, and we'll hope to see you in another session soon.